Want clear trends in Excel? Let's compare the 21-day and the 50-moving average in under 15 minutes. Okay. Welcome to the Excel Chart Lab. Today we're walking through two of the most important tools for understanding price trends: simple moving averages, or SMA, and exponential moving averages, or EMA. These are the building blocks for almost every trend-based technique you ever use in Excel. But before we get started, this Excel tutorial video is for educational purposes only. It is not for financial, investment, or trading advice. Everything you see today is simply an example of how to work with stock data in Excel. Let's begin with the SMA. The simple moving average takes the closing price over a set number of days, such as 21 days or 50 days, and averages them. As each new day comes in, the oldest day drops out, and the line moves on forward. Shorter SMAs, like 21 day, react more quickly to the recent price changes. Longer SMAs, like 50 days, smooth out the fluctuations and reveal the broader trend. So let's begin with the simple moving averages, and you can see they really are simple. We're going to say 20 days, okay, then we're going to do 50 days. Again, it's called simple for a reason, right? It's just a straight averaging. Let's continue this down. There we go. Okay, now let's do a very quick plot. With the closing price and the two moving averages, the two simple moving averages. Okay, come over here. Now you come over here again. As always, you'll come over here and let's try 9. Okay, good, close enough. And now you can see. Well, let's do this. Let's get rid of some of the data. Let's only look at the last 3 months, okay? Because November just came to an end. All right. Now let's do a plot. Insert line plot. Here again. Let's try 10.5. There we go. Okay. Now let's take a very quick look at this plot. This is Ford Motor Company data, I believe. The blue line is the closing price. The orange line is the 20-day simple moving average. The green line is the 50-day simple moving average. Okay, you can see a couple times here back in October, it actually dropped below the 50 moving average, which could be seen as being a negative trend. But you can see it rebounded pretty quickly and came back up, did it? The main thing here, for the most part, the closing forward price has been above the 50 moving average, and that's normally considered to be a positive uptrend. But now you can see the 20 moving average. Okay, how there's more movement in the line. It actually crossed the line here. It actually crossed downward back on October the 10th. Crossed back above both lines on the 17th. Fell below the 20 moving average on the 17th, November 17th. Touched the 50, and now it's back above the 21-day moving average. Okay, so that's a very simple example of how to do moving averages. Simple moving averages. Now let's talk about EMAs. The exponential moving average also smooths prices but gives more weight to recent days. That means the EMA responds faster to market changes than SMAs. Here's the key difference. The SMA treats every day equally. Each day carries the same weight. EMA gives more influence to the most recent prices. so it follows the price movement more closely. Now let's take a look at the two EMAs. First thing you want to do is you want to set a, first thing you're going to do is bring all of our data back, okay, there. Come down to the 21. You want to come down here. You want to set a seed value, okay. 20, now here's a line. You get the formula is not really very complicated. You perform the function inside the parentheses first. Is that right? So it's B21 times 2 divided by this has to be changed to a different number, I believe. It's this. All right. So this goes. Yeah, so this should be a B, right? All right. So there's that. Let's set our seed for the 50 now. Then we can compare the results. Set our seed up here again. Interesting, we got two different models here. Let's go ahead and use, since we used the first one up here, let's use this one here also. B, C, D, E, what is this? F, right? F50. Now you can look here already, you can see there's a difference. The first value is 9.92, this one is 9.62. Because the farther it is, the further back in time we go, the less important the number is, okay? So you can, again, let's take a look here. So 9.92, 9.6, 9.97, 9.64, 10, 9, and so forth, okay? So now let's come back up here again. Let's get rid of our, let's go back with just the last 3 months worth of data, all right? First, let's look at just the two EMA. First we'll look at the two EMAs, then we'll compare the EMA to the SMA, okay? Plot. Now you can see how much, there's an obvious difference between the 20-day EMA, right? You can see how much it really pretty closely follows the actual line. Now look at this, it's got all the rises and fall, all the increases and decreases, almost the same level of increase and decrease of the price, the same. It's not a lot of change in the 50 moving average line. But again, you can see we still got the same crossover event here. Okay, and it briefly kisses the 50-day line here. All right, so it's kind of interesting how you got the couple crossover events on the 21-day moving average. Okay, so now let's get rid of that. And let's just compare the moving averages themselves. First the 21-day. Once again, come over here. Okay. Now look at the difference between the 21-day SMA, the blue line, and the 21-day EMA. That's a huge amount of difference, isn't it? Huh. Interesting. Now let's compare the two 50s. Now there probably won't be as much difference on this one because, okay, there is a difference. You can see once again that the 50-day EMA is a little more responsive. Okay, it is above it's a little more, but the overall trend is the same for both. But there is a slight bit of difference up here in there. You can see once again it's a little more slope, a little more shape uh, to the 50 EMA there is to the than there is to the 50 SMA. Okay. So let's go back now. For the sake of YouTube, let's go back. Let's do 50 SMA and 20 EMA, okay? And this will be our concluding plot for today. Okay, and there you have it. The closing price, the 20 exponential moving average, and the 50 simple moving average. Okay, let's make this a little larger, just in case YouTube wants to have it. Here's a simple way. Let's see now. This is why the EMAs are often used for trend signals, momentum shifts, and crossover strategies. Here's a simple way to think about it. Use the 21-day SMA or EMA for trend lines that react to shorter term moves. Use the 50-day SMA or EMA for slower, steadier trend line indicators that filter out more volatility. Most charting setups combine both, one for responsive, the other for simplicity. In this tutorial, we've calculated 21 days and 50-day SMAs along with matching EMAs. Then we plot them on a chart so you can visually compare how each average reacts to price changes. By the end, you'll see the difference between the responsive line, trend line, and a long-term smoothing line. If you found this helpful, be sure to like the video, subscribe, check out the rest of the actual chart lab tutorials. All right, let's